Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we'll have a look at some of the latest tariff announcements from the US and gauge their expected impact for growth and inflation in the US. We'll have a look at what's priced into the US equity market and European equities and Japanese equities at this point in time. And finally, we'll have a look at concentration across the globe. We're going to start off with tariff announcements. As of all the tariffs that were announced up until Friday, the effective tariff rate in the US from the 1st of August would be around 18%. And given the tariff announcements over the weekend with regards to tariffs on European and Mexican goods, it's likely to be a bit higher than that. The difficulty in trying to estimate what that means for growth and inflation stems from the fact that this would be the highest tariff rate since the 30s. And it's a very rapid change. And we don't have any recent history to go by. So it's very difficult to go and model what the impact would be. We can use data from prior to the 1930s, or we can use smaller changes and try to gauge what impact they would have on growth. But there's going to be wide bands of uncertainty around any forecasts. And I think the most we can say at this point is that the tariffs, as announced, are likely to detract somewhat from growth and add somewhat to inflation. But I don't think we can be more precise than that for now. We need to wait for some data in August and September, should the tariffs persist at those levels, to be able to be more precise. As an example of some counterintuitive results, if we look at used car prices in the US, they haven't moved by much. There's been a 25% tariff on imported cars in the US for a couple of months, but last month, if we look at changes in used car prices, they were only up 1.5% month on month, up around about 6% year on year. So it does seem that there is some degree of inflexibility with regards to used car prices at least, and we do need to wait and see. Maybe you have to wait a couple of months to be able to fully gauge what knock-on consequences we will see for domestic prices and what knock-on consequences there will be for margins for US importers as well. In addition to the country tariffs, we heard last week that there'd be a 50% tariff on copper too. That is a little difficult to understand given the importance of copper for the energy transition in general and AI in particular, and the fact that there's very limited ability to produce copper or mine copper in the short term in the US. It takes a very long time to develop a mine, and there's lots of regulatory requirements too that take a lot of time. So it's not immediately clear why there's a 50% tariff on copper or if it will persist. But what we've already seen is a spike in US prices of copper. At the moment, US copper trades at about a 25% premium to global copper. And should these tariffs persist, we would expect that that number would go up. It's hard to see how this is anything but a headwind for the US economy. Even so, despite all the uncertainty associated with the tariffs that have been announced, will these tariffs persist at current levels? Will they come back a little bit? What is the growth impact? What is the inflation impact? There's a lot of uncertainty. Despite all of that, volatility in the US and globally still remains relatively low. And we can see that both for equities and for fixed income. And it does appear to be the case that the market is pricing in these tariffs to not persist. But there's a bit of a conundrum there. It seems to be the case that the market is pricing the tariffs to come back, but the Trump administration doesn't need to pull back the tariffs as long as the market is relaxed about them. So we have to wait to see how this develops. And in the interim, as we'll touch on shortly, the US market is back at a record high. And I think there's a couple of reasons for that. The first is growth, which we'll talk about shortly, and the second is earnings. On the growth front, the latest high-frequency estimate from the Atlanta Fed suggests that the US economy was growing at about 2.5% in Q3. That's well above the consensus forecast, and I think provides some reassurance for the market, i.e. growth is still good for now. It may well deteriorate in time, but it's still okay for now. And in addition, there's very little sign of financial stress, either in the US or in Europe. And both of those would lead to some degree of comfort for market participants, and I think go in some way in explaining why the S&P 500 was back at a record high on Thursday. And if we look at the market response to the tariff announcements over the weekend, it's been fairly muted. The S&P futures at the time of recording this was down around about 50 bips or so. So we are seeing quite a muted response to tariff announcements in general, and the market seems to be quite relaxed because of good growth numbers and earnings numbers. there is an inadvertent consequence of the S&P 500 being back at a record high, and that is that there's a global concentration issue. The US market is now 70% of the broader developed market index, and that's despite the fact that over the past year we've seen quite sizable outperformance from rest of world equities relative to the US. And what that means is by simply tracking the developed market index, one has a pretty sizable bet on the dollar remaining strong, given that 70% of that index is the US market. But it's not just that there's a concentration issue at the developed market index level. There's a concentration issue in a range of different countries. There's been a lot written about the concentration in the US market post the rally in the Mag 7, and the top 5 stocks in the US now account for 25% of that index. But if you look at a range of other countries, they're much more concentrated than that. And what that tells us is that by simply tracking benchmarks, we're taking on a lot of concentration risk in a range of countries. And even if you do it at the global level, you're taking on a lot of concentration risk with regards to one particular country. It makes a pretty strong argument for diversifying away from the simple benchmark indices. Switching to valuation, it's quite often the case that a dividend discount model is used to try to get an estimate of fair value for an index or for a company given an expected stream of dividends. Now, we can flip that formula around and we can say, given current prices, what is the future stream of dividends that is priced in to an index or company? And if we do that for the US market at this point, the US market, under a set of assumptions, is currently pricing in long-term persistent dividend and earnings growth of around about 7% per annum. It's much lower in other parts of the world, and that 7% per annum is a pretty high number when you consider that long-term inflation expectations should be around about 2%. So in effect, the market is saying inflation will be about 2%, and there'll be 5% real earnings growth in the US market. Now, the difficulty with that is that earnings growth over time should correlate with GDP growth. And if the market is pricing in 7% nominal earnings growth in the US, i.e. 5% real earnings growth in the US, it must be then either pricing in 5% GDP growth, which we know is not the case, or it must be pricing in the US market, to US corporates, to gain increasing market share outside of the US. So there'll be 2 to 3% growth in the US plus growth from the rest of the world, implicitly pricing in greater globalization. Now, that's the first issue, because we've seen from the tariff announcements that globalization is under threat, but the market somehow is pricing in globalization to continue as a starting point. But then it's also pricing in globalization to continue for US corporates, not for corporates elsewhere in the globe. If you look at what's priced into European equities are expected to grow earnings by about 3.5% through the cycle. Now, 3.5% makes sense. You're going to have inflation of about 2 and GDP growth of 1.5, so you'll get to earnings growth of about 3.5. That assumes no globalization. So there's interesting contrast between what's priced in the US, which is for globalization to continue, and what's priced into Europe, which is for globalization to not continue. And there does seem to be a disconnect and some level of optimism priced into the US market, especially when one considers that margins at this point are pretty high in the US, both relative to history and relative to the rest of the world. And it does lead one to be a bit concerned around valuation at this point in the US, both in terms of the concentration story and the fact that it does seem to be the case that there's a lot currently priced into the US stock market. And that's where we're going to end it this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that I reference in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity derivatives, currency derivatives, bond derivatives, and interest rate derivatives markets, an authorized financial services provider and a registered credit provider.